Good morning, participants. I hope you are all able to hear me and also see me. If anyone is having transmission problem, video or audio, please point out before we start today's session. So in our last session, we started discussing on statement of changes in equity. So we look at this particular exercise today, which shows the trial balance of AB Limited as on 31st March 20x7. So various items of income, expenditure, everything is given here. Administration expenses to 50,000, distribution cost to 95,000, share capital to 70,000, share premium account 80,000, revaluation reserve 20,000, dividend 27,000, cash at bank and in hand 3,000, receivables to 33,000, interest paid 25,000, dividends received 15,000, interest received 1,000, land and building at cost, land 380,000, building 100,000, total 480,000, land and building accumulated depreciation 30,000, plant and machinery at cost 400,000, plant and machinery accumulated depreciation 170,000, retained earnings account as at 1st April 2006, that means at the beginning of the year, 235,000, purchases 1260, sales 2165, inventory as on 1st April 2006, that means opening inventory 140,000, trades payable 27,000, bank loan 100,000. So this is the trial balance of a particular company as at the end of the reporting period 31st March 20x7. So using these numbers, additional informations are provided. Inventory, the closing inventory, that is inventory on 31st March 20x7 was valued at cost 95,000. Included in this balance of 95,000 were goods that had a cost of 15,000. These goods had become damaged during the year and is considered the following the remedial work. The goods could be sold for 5,000. So within this 95,000, which is the cost of the closing inventory, there are goods which are held at a cost of 15,000, but the goods have become damaged during the year and it is considered that following remedial work, the goods could be sold for 5,000. So we can understand there is already an impairment of 10,000 in those goods. The following rate of depreciation is to be charged for the year till 31st March 2007 against the cost of sales. Building at 5% of the cost on straight line basis. Plant and machinery 30% of the carrying value on reducing balance method. Income tax of 165,000 is to be provided for the year till 31st March 2007. Land is to be revalued upwards by 100,000. Now we have to prepare the statement of profit or loss and OCI and statement of changes in equity for the year ended on 31st March 2007. Based on this trial balance, figures and also information provided here regarding inventory, regarding depreciation, revaluation of land, income tax provision, etc. So let's look at the solution. First we look at the statement of profit and loss and other comprehensive income for the year ended 31st March 2007. So revenue is 2165. Let's work out the cost of sales. So the cost of sales is, let's try to work out the cost of sales. Opening inventory, $140,000 plus purchases, $1,260 during the year, and closing inventory. Remember, 95,000 is the value of the closing inventory at cost. In this included cost of goods worth 15,000, which can be sold for 5,000. So the actual value of the closing inventory is $95 minus 10, which will be the write down of the inventory, because 15,000 worth of inventory which is the value at cost, had been damaged during the year, and following some remedial work, this can be sold only for 5,000. So there would be a write down of the inventory to the extent of 10,000. So closing inventory will take at 95 minus 10, that is 85,000. Then you have to charge for depreciation. Now the depreciation rate is 5%. Let me go back to the building is 100,000, that is the 5% of 100,000 plus 33% of the plant and machinery written down value, which is 400 minus 170. So 230 is the written down value of plant and machinery. 400 is the plant and machinery, cost of plant and machinery. 170 is the accumulated depreciation. So the written down value or carried value of the plant and machinery is 230,000, and our information says %30 of the carrying value. So depreciation is 5% of 100 plus 30% of 400 minus 170, which is the carrying value of the plant and machinery. So it comes to 5 and 69. 5% of 100 is 5, 30% of 230 is 69, so 74 is the depreciation. So this has to be subtracted. So total is 1389. This is the cost of goods sold. Is that clear to everyone? How we arrive at the cost of goods sold? Opening inventory plus purchase minus closing inventory minus depreciation on the fixed assets. So revenue is 2165 minus cost of sales 1389. So gross profit is 776. Administration expenses is 295. Distribution expenses is 250. So operating profit is 231. Finance cost 25,000. Interest receivable is 1,000, and investment income, dividend income is 15,000. So profit before tax is 231 minus 25 plus 1 plus 15. So we are taking into account non-operating income and non-operating expenses. So 222 is the profit before tax. Income tax expense is 165,000. So profit for the year is 57,000. Is that clear? Now there is other comprehensive income of, because land has to be revalued by 100,000. So revaluation, gain on land revaluation is an item which cannot be included in the profit and loss account, so it will be reflected in the other comprehensive income statement. So gain on land revaluation is 100,000, so total comprehensive income for the year is 100 plus 57, 157,000. Up to this I hope it is clear, because we are only using the numbers which are provided in the trial balance and in the additional information. So any doubts, you please tell me before we move to the statement of changes in equity. Before we start working with the statement of changes in equity, if you have any doubts regarding statement of profit and loss and other comprehensive income, please let me know so that I can explain any number which is not clear to you here. I am waiting for your query, if any, regarding the statement of profit and loss and other comprehensive income which have been worked out based on the numbers available in the trial balance of the company and also in the additional information provided in the problem. So apparently you don't have any doubts, so we'll go to the statement of changes in equity. Now how to prepare the statement of changes in equity for the year ended 31st March 2007. So share capital at the beginning of the year, what are the various components of equity at the beginning of the reporting period, that is on 1st of April 2006. So share capital was 270,000, share premium account 80,000 balance, revaluation surplus 20,000, retained earnings 235,000 opening balance. So total equity was 605, that is the opening as of 31st March, as of 1st April 2006. That was the position of various components of equity and total equity. Now, how the equity has changed during the year? Equity has changed during the year due to profit earned during the year and other comprehensive income. So total comprehensive income for the year is added 100,000 due to revaluation, gain on revaluation of land, so it will be reflected on the revaluation surplus, and 57,000 profit after tax. From statement of profit and loss we are getting this number, so it will be placed under retained earnings column. Total equity, increase in total equity is 157,000. Then dividends have been declared during the year. There is the trial balance we saw, dividend accounts has a balance of 27,000. So dividends have to be reduced from the retained earnings. It's a basically reduction of the equity. When dividends are paid out, equity gets decreased or depleted. So 27,000 will be reflected on the retained earnings. So the closing balance of the various components of equity will be as under: 70,000 share capital, 80,000 share premium, revaluation surplus 120,000, retained earnings 265,000, which is 235 plus 57 minus 27, and total equity 605 plus 157 minus 27, which is 735, which is basically the sum of the individual components of equity under share capital, share premium, revaluation surplus and retained earnings. This is how the statement of changes in equity for this company will look like as at 31st March 2007. During the year, how the equity has changed. I hope this example brings out very clearly the interlinkage between profit and loss account and another comprehensive income account, and also the statement of changes in equity. Any questions? This is the time to ask for it. So I am waiting for your questions. If you have any doubts, please have it clarified before we move to the next slide. So apparently you don't have any doubts because I didn't get any questions from you while we discussed about the statement of profit and loss and other comprehensive income, and also during preparation of the statement of changes in equity. So let me move on. Now we'll talk about the difference between IFRS and US GAAP. So far as statement of changes in equity is concerned. So what are the points of difference between IFRS, International Financial Reporting Standard, and US GAAP? As you know, statement of changes in equity, there is no separate guidance under IFRS. IS1 covers statement of profit and loss, statement of financial position, or statement of changes in equity. These statements are covered under IS1. There is separate guidance IS7 for only statement of cash flow. But for the remaining components of the financial statements, IS1 is the guidance issued by IFRS. Under US GAAP, this is covered under ASC 215. So we'll talk about the points of difference between IS1 and ASC 215 so far as statement of changes in equity is concerned. So first point, first area of difference, or first area where we are comparing is basically comprehensive income in the statement of changes in equity. IFRS doesn't permit the components of a comprehensive income to be presented in the statement of changes in equity in lieu of the statement of a comprehensive income. Without having a statement of comprehensive income, IFRS will not permit components of a comprehensive income to be presented in the statement of changes in equity. So it will be first shown in the statement of total comprehensive income or separately as the statement of other comprehensive income. Like say the revaluation, gain on revaluation of land, it's a basically component of a comprehensive income. Unless it is shown separately, either in the statement of total comprehensive income or separately in the statement of other comprehensive income, if it is not shown separately, it cannot be included in the statement of changes in equity. IFRS doesn't permit it. So any component of a comprehensive income can be presented in the statement of changes in equity, provided it has been shown separately in the statement of total comprehensive income. Either it has been shown in the statement of total comprehensive income or separately in the statement of other comprehensive income. Whereas IFRS has this requirement, US GAAP permits the components of comprehensive income to be presented in the statement of changes in equity in lieu of the statement of a comprehensive income. Even without having a statement of comprehensive income, if it is not there, then even US GAAP permits the components of comprehensive income to be presented in the statement of changes in equity. So that is the important area of difference between IFRS and US GAAP so far as statement of changes in equity is concerned. So we have completed our discussion of statement of changes in equity. It is one of the key components of the financial statement. It is particularly useful to the investors, lenders, equity holders and auditors. Now I have a small announcement to make which I will also be putting up in the cloud group for your batch. Next week, that is on 31st May and 2nd June, these 2 days we have got classes, 9 to 11. The classes will be extended till 1 p.m. So instead of having 2 hours of session on 31st May and on 2nd of June, you will have 4 hours of session. So please remember, on 31st May 2017 and 2nd June 2017, classroom sessions for batch number S160083 will be from 9 a.m. to 1 p.m. Please note it down on next Wednesday and next Friday. Wednesday and Friday of the next week, these are the last 2 days of your sessions. The CS sessions will be held from 9 a.m. to 1 p.m. because we have missed some sessions due to in the last week, I think 15th week, starting from 15th we missed one session. The session on 17th could not be held due to studio maintenance. I think another session was missed some time back. So to make up for those sessions which we have lost earlier due to unavoidable reasons, we are going to hold extra sessions next week. So the timing of the classroom sessions next week will be from 9 a.m. to 1 p.m. Please note it down. Now we are going to talk about the last component of a complete set of financial statements. We have already discussed statement of financial position. We have already discussed statement of profit and loss and statement of other comprehensive income. We have already discussed statement of changes in equity. So now we are going to talk about the last important component of a complete set of financial statement, which is statement of cash flow, SOCF. SOCF or statement of cash flow, there is a specific guidance is available in IFRS for this particular component of financial statement. That guidance is available under IS 7. International Accounting Standard 7 is the guidance issued by IFRS, under IFRS for preparation of cash flow statement. So we'll talk about the need for a cash flow statement and IS 7, which is the relevant guidance. We will understand the different business activities for which cash flow is prepared. We will talk about the treatment and accounting requirements and the difference between IFRS and US GAAP so far as this particular statement is concerned. Yes, Divya, what is your question? Your MT is on, if I remember correctly, your MT is on I believe it is 5th of June. I think it is 5th of June. Just check up with your center. So tomorrow, next week will be your last classroom sessions. We'll complete the course in the next week. We are going to finish lesson 3 today. We'll start on lesson 4. And lesson 4 is the last one we have to cover. I think, as I remember correctly, your MT is on 5th of June. But please check it again with your center, or you can check it from your by going to nitstudent.com by checking with your batch schedule. IS 1, which deals with presentation of financial statements, makes it incumbent upon entities, makes it necessary for the entities preparing financial statements under international financial reporting standards to present a cash flow statement as an integral part of the financial statements. So IS1 makes it necessary or incumbent upon entities which are preparing financial statements under international financial reporting standards. They must present a cash flow statement as an integral part of the financial statement. IS7 is the relevant guidance for cash flow statement. It lays down rules regarding cash flow statement preparation and reporting. So IS1 is the guidance for preparation of financial statements. IS1 is the relevant guidance under IFRS for preparation of financial statement. IS1 makes it incumbent upon entities preparing financial statements under IFRS to present a cash flow statement as an integral part of the financial statement. But the relevant guidance for preparation and presentation of and reporting of the cash flow statement is available under a separate guidance which is called IS7. For other financial statements like statement of financial position, statement of changes in equity, statement of profit and loss, or other comprehensive and statement of other comprehensive income, we do not have separate guidance relating to the preparation and reporting of those financial statements. That is available under only IS1. But IS7 is a separate guidance which has been created for preparation of the cash flow statement and presenting it, reporting it. The cash flow statement basically provides information about an entity's cash receipts and cash payments. That is cash flows. Cash receipts constitute cash inflow. Cash payments constitute what we call cash outflow. So, the cash flow statement provides information to the users about an entity's cash receipts and cash payment, that is cash flows, for the period for which the financial statements are presented. So the purpose of a cash flow statement is to provide information to the users of the financial statements regarding cash flows, that is cash outflow and cash inflow, for the period for which the financial statements are prepared. That is the purpose of a cash flow statement. So it is useful to the users to know how much cash has been received by the business during the reporting period and how much cash has been paid out by the business during the same reporting period. Now, cash flow is significant in identifying a few things. Number one, what are the important things that can be identified or by using the cash flow statement? Whether the regular operations of the entity generate enough cash to sustain the business. See, every business, when it carries out its business activities, the ultimate result is in generation of cash. Now, generation of cash must be adequate to support or sustain the business. If an entity is carrying on a business and it is not generating enough cash to sustain the business, the entity cannot continue. So it is important for a user to know whether the entity is generating enough cash to sustain the business. That will be the regular operations of the entity, whether it is providing enough cash or generating enough cash to sustain the business. That is very important to know. If it is not, then the entity will have to possibly borrow money, go for financing activities, things like that. It cannot, the operations of the business, if it is not generating enough cash to sustain the business, then possibly the entity will have to resort to borrowings and all that. So it is important for an user to know whether the regular operations of the entity is generating enough cash to sustain the business. Whether enough cash is generated to pay off the existing debts as they mature. Secondly, whether enough cash is being generated which can be used to pay off the existing debts as and when they mature. That is also very important point to know. whether the entity is generating enough cash to sustain the business, whether the entity is generating enough cash to pay its debts as and when they mature, whether the entity can acquire new business opportunities in the future, whether there is enough cash generated by the entity so that it can acquire new business opportunities in future whenever a suitable business opportunities are available, whether the entity will be in a position to acquire that business opportunity, whether the entity is likely to need an additional financing. If an entity is not generating, if the regular operations of the entity is not generating enough cash to sustain the business or not generating enough cash to pay off the existing debts as and when they mature, if the entity is not generating enough cash to acquire new business in future, then the firm will likely need additional financing. There will be likely need of additional financing, so they will have to raise money from outside for either to support their existing business or to pay off the debts as and when they mature or to acquire new business. Whether entity will be in a position to meet unexpected obligations. Sometimes every obligations cannot be foreseen. Each and every obligation of an entity cannot be foreseen or cannot be anticipated. So there can be some unexpected obligations can arise at certain points of time. Whether the entity will have enough cash to meet or cope with unexpected obligations. So these are the things which can be identified through analysis of the cash flow statements by an user. So an user will be naturally interested to know. An user like an investor or a lender will be interested in knowing some of these points. So that's why they will look at the cash flow statement. So the cash flow statement basically provide additional information to its users regarding solvency, liquidity and financial structure of an entity. Additional information, we get a lot of information from the other financial statement, but we need to know ultimately, even after understanding and carrying out ratio analysis with the help of statement of financial position, statement of profit and loss and all that, so that you can understand the solvency aspect of the business, liquidity aspect of the business, financial structure of the entity, we also need to know how much cash is actually being generated by the entity. Because at the end of the day, the cash that is being generated will really matter. Entity may be making profits, but ultimately if they don't have enough cash to pay off its obligation or to sustain the business, the entity may get into trouble. So it is important to know how much cash is really being generated by the business. See, all of the statements are prepared on accrual basis. If you look at all of the statements, these are prepared on accrual basis. CFS is the only statement that is prepared on cash basis. Although the books of accounts are maintained on an accrual basis and the statements, financial statements, like statement of income, profit and loss, statement of other comprehensive income, statement of financial position, even statement of changes in equity, all these are prepared on accrual basis. The underlying basis is accrual, concept of accrual. But cash flow statement is the only statement which is prepared on cash basis. Because we need to know how much cash is really available with the business during a particular reporting period, how much cash was available at the start of the reporting period, how much cash flow, how much cash was received from various business activities, financing activities or investment activities, how much cash was flew out or the outflow of cash, how much cash went out during the reporting period and how much cash the entity is left to at the end of the reporting period. This is what we get from a cash flow statement. So opening balance of cash plus cash inflow minus cash outflow will constitute what will give us what is called the closing cash balance. So you need to know we are basically doing a reconciliation between the opening cash and the closing cash available with the business. So we start with the opening cash balance, add all the cash inflows, total of the cash inflows, add it to the opening balance of cash, minus cash outflows during the period. That will give us, that should give us the cash available in the business at the end of the reporting period. That is what is a cash flow statement. It is again a reconciliation statement like statement of changes in equity. Remember, statement of changes in equity is a reconciliation statement. Opening balance of various components of equity plus increase or decrease in these components of equity during the reporting period. That will give us the closing balance of the various components of equity. So it's basically a reconciliation statement. Similarly, cash flow statement is also a reconciliation statement, but it is prepared only on cash basis. So opening balance of cash plus cash inflows minus cash outflows will give us what is called closing cash balance, or cash balance available at the close of the reporting period. That is what is a cash flow statement. Now we'll discuss about what we mean by cash and cash equivalents. Cash we all understand. Cash equivalents are basically highly liquid short-term investments within 3 months of maturity. With 3 months of maturity. So we are looking at highly liquid kind of assets which are highly liquid, basically short-term investments which are going to mature within 3 months. For example, highly liquid government or central bank bonds. So the figure on this slide provides you, it represents cash and cash equivalents. So cash and cash equivalents comprises of cash plus cash equivalents. Cash can be in the form of cash on hand or demand deposits, including bank overdrafts. So a company, if it is enjoying a overdraft facility from a bank, or if the company is maintaining a current account and balance is maintained in the current account, or whatever cash is held with the entity at on a particular date, that constitute that cash, and short-term investments with 3 months of maximum 3 months of maturity, they constitute cash and cash equivalents. So when we talk about cash, we are not only talking about cash, but also cash equivalents. So cash and cash equivalents we are going to talk about. These are important for understanding the cash flow statements. So cash equivalents are basically held by the entity for meeting short-term commitments. When an entity makes investment in short-term investments like liquid government bonds or central bank bonds, which can be sold in the market at any point of time, or which are going to mature within 3 months, then basically these are done by the company for meeting their short-term commitments. Even if they invest in money market mutual funds, that will also be considered as cash equivalent. So investments made by the company in short-term investments which can be liquidated within 3 months are considered as cash equivalents. This type of investments are made by the company when they have surplus funds, instead of keeping it in the current account, because current account entity will not earn any interest by keeping that money in the current account. But if they invest in short-term investments or money market mutual funds, etc., entity can get a return on those kind of investments. The short-term investment can even be fixed deposits with bank maturing within 3 months. It can be government bonds or central bank bonds, RBI bonds. It can be money market mutual fund, all of which can be liquidated within a period of 3 months. So this is done by the company with specific purpose of earning some return on their surplus cash. So these are part of our cash and cash equivalents. So according to the definition, cash equivalents are required to possess 2 attributes. They should be short-term. Cash equivalents must be short-term in nature. That means they are held for meeting short-term commitments. So in other words, an investment normally qualifies as cash equivalent only if it has a short maturity, say 3 months or less from the date of acquisition. And the second point is that they should be highly liquid investments. 2 points are important. One is short-term nature of the investment. That means the investments are made to make basically for meeting short-term commitments. So the investment should mature within 3 months from date of acquisition. The second attribute is they should be highly liquid investments, which are readily convertible to known amounts of cash and are subject to an insignificant risk of change in value. So investment in shares even if it is held, if done for a short term, will not be considered as cash equivalent. So if a company wants to invest in shares for a period of only 3 months, that we cannot be considered a cash equivalent because there is a risk of change in value. There is significant risk of change in value. If you are investing in shares for a period of 3 months, within 3 months, the value of the investment can go up, can go down significantly. So investment in shares, even for a short term, will not qualify as a cash equivalent. So there should be highly liquid investments that are readily convertible to known amounts of cash and are subject to an insignificant risk of changes in value. That's why I mentioned money market mutual fund, because money market mutual fund has insignificant risk of change in value. Okay, so normally when investments are made in money market mutual fund, the principle is, because the money market mutual fund, the mutual funds invest in government securities, treasury bills, or certificate of deposit issued by banks, or commercial papers issued by highly rated corporates. So money market mutual funds are generally invested by the fund managers in this kind of asset classes, which have insignificant risk of changes in value. It is important to note movements within or between the items of cash equivalents are excluded from cash flows for the purpose of preparation of the cash flow statement. So any movement between the items of cash equivalent, that means if a part of the demand deposit held in the bank is invested in money market mutual fund, that's a movement between one item of cash equivalent to another item of cash equivalent. Such kind of movements within or between the items of cash equivalents are excluded from cash flow for the purpose of preparation of cash flow statement, as they are part of the cash management of the entity as opposed to its operating, financing and investing activities. So that's why we are trying to explain the concept of cash and cash equivalents, and please understand, any movement between or within the items of cash equivalents will not be considered for preparation of the cash flow statement, because it is only a part of the cash management of the business. So if the business decides to, it a surplus balance in current account, let's say it is carrying a balance of 5 crores in the current account. Now it has a transaction, it expects the maximum transaction need for funds will be, let's say, 2 crores during next 3 months. So the excess 3 crores that is carried in the current account can be converted into some other form of cash equivalent, let's say a fixed deposit with a bank for a period of 3 months, or investment in money market mutual fund for a period of 3 months. So this is a movement between of 3 crores from one type of cash equivalent, that is demand deposits with the bank, to another type of cash equivalent. Such movements of cash between items of one item of cash equivalent to another item of cash equivalent will not be considered for our cash flow statement. That will neither be considered as an outflow nor an inflow. Please understand. Because this is part of the cash management activity of the business. It is not part of the financing, investment or operating activities of the business. So those kind of movements between movements of cash between items of cash equivalent will not be considered for the cash flow statement. That's why we are trying to explain what we mean by cash and cash equivalents. So cash equivalents have two very important attributes. One is short-term nature. Nature of the investment must be short-term. Maturity not exceeding 3 months period of maturity. Second thing, it must be highly liquid. That means it can be readily converted into known amounts of cash. It must be highly liquid investment. It can be converted into known amounts of cash. There is no significant risk in change of value. These two attributes are very important to identify whether something is a cash equivalent or not. Whether an investment is to be considered as a cash equivalent or not. Okay. Now the statement of cash flow can be classified into, it has actually 3 parts. It can be classified into following 3 categories. One is the operations. So cash received and paid for day-to-day activities with the customers, suppliers and employees. So operation involves customers, suppliers and employees. So cash received and paid for day-to-day business activities with customers, suppliers and employees. This is operations. Second category is investing. Cash paid and received from buying and selling long-term assets. So cash paid for buying long-term assets, cash received from selling long-term assets. So when an investment is made, when a company acquires a plant and machinery, when a company acquires land or building, or when a company acquires a goodwill or some other intangible asset, that is an investment in a long-term asset. The cash that is paid out for the purpose will be considered as a cash outflow for investing activities. Similarly, when the company sells, company disposes a part of its fixed assets, old fixed assets, used fixed assets, or whatever. That is the cash inflow generated from disposal of fixed assets will be a cash flow from investing activities. And third category is financing activities. So financing activities constitute cash received and paid for exchanges with lenders and stockholders. See, operating activities basically cash received and paid for day-to-day business activities with customers, suppliers and employees, whereas financing activities will be cash received and paid for exchanges with lenders and stockholders. So here, transactions between the entity and its lenders, transaction between the entity and its stockholders. So any cash received or paid arising from transactions between the entity and its lenders or entity and its shareholders will constitute cash inflow or outflow or cash flow under financing activities. So you can clearly demarcate these three areas in a business. These three types of activities are there. One is operating activities, the other is the investing activities and financing activities. For each of the activities, cash inflow and outflow are basically worked out for preparation of the cash flow statement, and these are presented in this order: operating activities, investing activities and financing activities. So the cash flow statement provides information about an entity's cash receipts and cash payment, that is cash flows, for the period categorized under three headings. So there will be three headings for the cash flow statements. One is operating activities, one heading is the operating activities. The second heading for the cash flow will be investing activities, and the third heading for the cash flow statement will be financing activities, along with changes in cash and cash equivalents. Such classification of information provided by the cash flow statement allows the users of financial statement to assess the impact of each of those activities on the financial position of the entity and the amount of cash and cash equivalents by presenting this separately. So when the cash flow statement is prepared or presented, there will be three headings under which cash flows will be shown. Cash inflow and outflow will be shown. The three headings will be under operating activities, how much cash inflow and outflow took place; under investing activities, how much cash inflow and outflow have taken place; and under financing activities also, how much cash inflow and outflow have taken place. And the sum of all these three will provide you total cash inflow and total cash outflow during the period. So an user of the statement, since it is presented under each of these activities, such classification of information provided by the cash flow statement will allow the user of the financial statements to assess the impact of each of those activities on the financial position of the entity as well as on the amount of cash and cash equivalents. The impact of each of these activities, operating activities, investment activities and financing activities, how it impacts the amount of cash and cash equivalents. So user can assess by looking at the activities and their impact separately on the cash flow. So that is why the presentation, specification presentation of the cash flow statement should be done under three separate headings. One is for cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. We'll have a short break at this point of time, and then we'll continue with cash flow statement. Welcome back after the break. So the order of presentation of these three activities, how it is presented basically. In a cash flow statement, we start with the cash flow from operating activities. Now it can be done under two methods. One is direct method, the other is indirect method. Cash flow from operating activities can be shown under two different methods are available. One is called direct method, the other is called indirect method. And the second one, that is the indirect method, is the most widely used method. So after presenting the cash flow from operating activities, next comes the cash flow from investing activities and financing activities. In this order, the cash flow statements must be prepared and presented to the users. Now for this three, so what is the question? Portal empty date is shown as 9th of June. Then it is 9th of June. I was told it is 5th of June, but let me check it back. Whatever, if it is 9th of June also, your classes will be held only till next week. Let me check up. Classes for Wednesday and Friday have been scheduled from 9 to 1, so that stands now. If it is 9th of June, we'll see. Okay. So I will post it in the cloud group, so please go to the cloud group and check if there are any changes. It will be posted in the cloud group regarding class timings, etc. Now the order of presentation will be operating activities first. Cash flow from operating activities will be presented first. Here there are two methods available. One is direct method or indirect method of presenting the cash flow from operating activities, and the indirect method is the one more widely used or more commonly used by most of the entities. Then the cash flow from investing activities will be presented and cash flow from financing activities will be presented separately. The three sources of information for presenting cash flow under these three activities will be comparative balance sheets. So for we need the balance sheet of the earlier year and the balance sheet at the end of the reporting period. So the reporting period is from 1st April 2016 to 31st March 2017. We will meet the balance sheet as at the end of 31st March 2016 and also the balance sheet as at the end of 31st March 2017 for preparing the cash flow statement. The other will be the current income statement, that is the income statement for the reporting period, and additional information if any. So financial statement preparers, they have a choice between the direct and indirect method in presenting the operating activities cash flow. However, indirect method is widely acceptable and used in corporate reporting. Here we will be talking, when we discuss cash flow statements, we will be talking about indirect method. We will not be talking about direct method in this particular course, because indirect method is the most widely used method for reporting cash flows under operating activities. So what are the various type of operating activities under which cash flow will be reported? So cash inflow can be arise from sales made in cash, amount received from a debtor, that is also a cash inflow. A debtor has paid, account receivable has been paid by the debtor, so it will constitute a cash flow. Cash sales will constitute cash flow. Commission and fees which are collected in cash will constitute cash flows, and royalty payments received also will constitute cash flow statement, cash inflow. So cash inflow can arise out of cash sales, received from a debtor, commission and fees, and royalty. Cash outflow will result from cash purchases, payment to creditors, Sunday traders, Sunday debtors, etc. Cash operating expenses, payment of wages, income tax on the profit from operations, manufacturing expenses, etc. So this list is only illustrative list. There can be other items of operating activities from which cash inflow and cash outflow can result. So cash flows from operating activities are mainly derived from principal revenue generating activities of the entity. Remember, when you're talking of the operating activities, we are talking of the principal revenue generating activities of the entity. This is basically a critical indicator of the financial strength of an entity because it is the most important source of internal finance. It is the most important source of internal finance. So this is a critical indicator of the financial strength of the entity. Financial statement users usually look at the cash flows from operating activities as a measure of the entity's ability to maintain to sustain its operating capability and support other activities such as servicing of debt and repayment of borrowings, paying dividends to shareholders, making investments without recourse to external funding. So this being the principal revenue generating activities of the entity, it is a critical indicator of the financial strength of the entity. It is the most important source of internal finance. The financial statement users normally look at this cash flow from operating activities to measure the entity's ability to maintain its operating capability and support other activities like servicing of debt, repayment of borrowings, paying dividends to shareholders, making investments without recourse to external funding. So the list here is only illustrative and not exhaustive, as I told you. These are only some examples of cash inflow and cash outflow from operating activities. There can be other items of cash inflow and cash outflow from operating activities. Now, investing activities, the various type of investing activities which can result in cash inflow and cash outflow are: for cash inflow, sale of fixed assets or property, plant and equipment; sale of investment, that is debt or equity of other entities; interest received; dividend received; working capital recovery. These all constitute cash inflow from investing activities. Similarly, cash outflow from investing activities, the items are purchase of fixed assets or property, plant and equipment; purchase of investment, that is debt, equity of other entities; loans to other entities; working capital or tax paid on capital gains. So investing activities include the purchase and disposal of property, plant and equipment and other long-term assets such as investment property. They also include purchase and sale of debt, equity and debt instruments of other entities that are not considered cash equivalents or held for dealing or trading purposes. So sale and purchase of sale and purchase of debt instruments of other entities which are not considered as cash equivalents, which are not treated as cash equivalents. If these are for cash equivalents, they will not be appearing in the cash flow from investing activities. So if a company invests in RBI bonds for a period of 3 months, that is a cash equivalent. That cash outflow will not be reflected in the cash flow from investing activities. So basically, purchase and sale of debt and equity and debt instruments of other entities that are not considered cash equivalents or held for dealing or trading purposes. Investing activities also include cash advances and collection on loans made to other entities. And the various types of financing activities are: cash inflow can result from financing activities due to issue of shares in cash. When a company issues shares and receives cash against that will be cash inflow. Issue of debentures in cash. Proceeds from long-term borrowings. These constitute cash inflow. Cash outflow could be payment of loans or debts from other entities or banks, redemption of preference shares, payment of dividends, interest paid, repayment of finance or lease liability, buyback of shares, dividend tax paid. These are examples of cash outflow from financing activities. Financing activities include obtaining resources from and returning resources to owners and lenders. So also included in this category is obtaining resources through borrowing, short-term or long-term, and repayments of the amounts borrowed. So that constitute financing activity. Now what happens to non-cash transactions? There are various non-cash investing and financing activities that should be excluded from the cash flow statement. There could be non-cash investing and financing activities. Examples of that are conversion of debt, convertible debenture to equity. When a convertible debenture gets converted to equity, supposing the company has invested in convertible debenture and that eventually gets converted into equity of another entity. So this is a non-cash transaction. Neither any cash inflow took place nor any cash outflow took place. The investment made in debenture has been converted to equity, so it is an example of a non-cash activity. Issuance of share capital to acquire property, plant and equipment. A company acquired property, plant and equipment, and instead of paying out in cash to the supplier of the property, plant and equipment, they issued shares of the entity in favor of the supplier of the equipment. So here no cash transaction took place between the equipment supplier and the company. So issuance of a share capital to acquire property, plant and equipment again is a non-cash transaction, so it will not be reflected in the cash flow from investing activities. IS 7 requests that non-cash investing and financing activity should be excluded from the cash flow statement and reported elsewhere in the financial statements. Maybe in the notes to financial statements, where all relevant information about those activities is disclosed. So IS 7, the guidance available for preparation and presentation of cash flow statement, it requires that non-cash investing and financing activities must be excluded from the cash flow statement and should be reported elsewhere in the financial statement. Elsewhere means in the notes to financial statements, where all relevant information about those activities should be disclosed. This requirement is interpreted as the necessity to disclose non-cash activities to the footnotes to financial statements instead of including them in the cash flow statement. So non-cash activities for investment or investing or financing activity under section, any non-cash transaction should be reported by way of footnotes in the financial statements instead of including them in the cash flow statement. So we'll look at a cash flow statement, how it is presented using the indirect method. The table displays the cash flow statement from operating activities using the indirect method, how indirect method is used. So for using the indirect method, the starting point is always net profit before tax. The first item would be net profit before tax. That is the starting point. We start with that number. Then we make adjustment for the non-cash items which have been included, which have been considered for arriving at the net profit before tax. What are the non-cash items? Depreciation, amortization, etc. So adjustment for the non-cash items are made. Depreciation, whatever depreciation has been charged during the year, or amortization made during the year. Adjustment of non-operating activities like loss or gain on sale of fixed assets, loss on revaluation. These are basically these are not part of the operating activities, these are part of the investment activities. So you have to make adjustments for non-operating activities, loss or gain on sale of fixed assets have been considered to arrive at net profit before tax. So you have to make an adjustment of non-operating activities like loss or gain on sale of fixed assets, loss or gain on revaluation, etc. Then we basically get what is called operating profit before working capital changes. So when the net profit is adjusted for non-cash items or adjusted for non-operating activities, then what we gain is operating profit before working capital changes. Now adjustment is made for working capital changes. So trade and other receivables, the working capital components are trade and other receivables. Changes in trade and other receivables have to be adjusted. Inventories or stocks have to be adjusted. Trade payments or creditors and bills payable has to be adjusted. Then what we get is cash generated from operations. This is the cash flow from operating activities. Then we subtract interest paid and taxes paid to get the net cash flow from operating activities. So this is how the cash flow statement from operating activities is presented or prepared or presented under indirect method. So under indirect method, the starting point is always net profit before tax. That is the starting, that is the number we start with. Then adjust for the non-cash items, make adjustments for non-operating activities. We arrive at the operating profit before working capital changes. Then we take into account the changes in the components of working capital like trade and other receivables, inventories or stock, trade payments. So make adjustment for the working capital changes. We arrive at cash generated from operations. Then from that we deduct the interest paid and taxes paid. So we arrive at the net cash flow from operating activities. The indirect method is the more popular of the two methods. Despite the recommendation by IAS 7 to present the cash flow from operating activities under direct method, IAS 7 makes a recommendation, it's not mandatory. Under IAS 7 there is a recommendation that the cash flow from operating activities should be prepared under the direct method, but despite such recommendation, the indirect method is more popular. Most companies follow the indirect method to prepare and present their cash flow statement from operating activities. A possible reason for this, why indirect method is preferred, is that the indirect method is easier to use than the direct method. It is basically convenience. Indirect method is easier to use than the direct method because it derives the net cash flows from operating activities from the net operating results for the year as reported in the income statement. So under the indirect method, the first item presented is the net income or loss for the year as reported in the income statement. Then non-cash items of revenue and expenses are added or deducted to arrive at the net cash provided by operating activities. For instance, depreciation on property, plant and equipment is added back because these expenses reduce the net income for the year without affecting cash from operating activities. Similarly, gain on sale of property, plant and equipment is deducted from net income for the year because it doesn't affect cash flow from the operating activities. Changes in inventory, account receivable and other operating assets and liabilities are used to convert the accrual basis, basically removed because the cash flow statement is prepared on cash basis. So to convert the accrual basis net income for the year to arrive at cash flows from operating activities, we make adjustments for changes in inventory, account receivable and other operating assets and liabilities. This is the way a cash flow from operating activities under the indirect method is prepared and presented. So let's look at the format of the statement of cash flow. So it starts with the cash flow from operating activities. So list of individual items will be presented there under that heading, and then we'll arrive at what is called net cash provided or used by operating activities. If the inflow is more than the outflow, then net cash used by operating activities will be reflected. If inflow is more than the outflow, then net cash provided by the operating activities will be reflected. If the outflow is more than the inflow under operating activities, then net cash used by operating activities will be reported. Then next will be presented the cash flows from investing activities. Here also the list of individual inflows and outflows will be provided with the amounts, and then we get net cash provided or used by the investing activities. Similarly, cash flows from financing activities will be reported next. Here also list of individual inflows and outflows will be provided along with the amounts. So we will arrive at net cash provided or used by financing activities. So net increase or decrease in cash is basically sum of all these three. Then we take the cash at the beginning of the reporting period, and net increase or decrease in cash plus cash at the beginning of the period will give us the cash at the end of the period. Then any non-cash investing and financing activities, this can be disclosed through notes to financial statements. If the amount can be reported, details can be provided in the notes to financial statements. So non-cash investing and financing activities, the amount can be reported, total amount can be reported, individual non-cash transactions can be shown there, list can be shown there, and the disclosures will be made through the notes to financial statements. So the various activities of the statement of cash flow, if you look at under the head for operating activities, it will be sale of goods or rendering of services, cash inflow due to royalties, fees and commissions, employees and suppliers, income tax. Under investing activities, cash inflow or outflow from purchase or sale of PPE and intangibles, sale and purchase of equity and debt instruments, advances or loans to other parties, then futures, forwards, options and swaps. Cash inflow and outflow relating to this. Financing activities, share issue, equity instruments issue or buyback, loans, notes and bonds and finance lease. So this will be the various activities of the statement of cash flow. Now interest and dividend. Regarding interest and dividend, there are certain differences between IFRS and US GAAP, so they should be classified in the cash flow statement. So the transaction is one of interest paid. IFRS, it can be reported, it can be shown under operating or financing. Any interest payments can be, the cash outflow due to interest payments can be shown either under operating or financing activities. In US GAAP, it can be only reported under operating activities, not under financing activity. Interest received. Inflow due to receipt of interest under IFRS, it can be shown under operating or investment activities. US GAAP, it can be only shown under operating activities. Dividends paid. Cash outflow due to dividends payments under IFRS, it will be either shown under operating or financing activities. Under US GAAP, it will be shown only under financing activities. Similarly, dividends received. Under IFRS, it can be shown under operating or investing activities, but under US GAAP, it will be shown only under operating activities. So these are some points of difference between treatment of interest and dividend receipts and payments, their classification in the statement of cash flow under IFRS as well as US GAAP. So for interest paid, interest received and dividends received, US GAAP requires that they should be reported under operating activities. For dividends paid, that should be reported under financing activities. Whereas under IFRS, interest paid and dividends paid can be reported under operating or financing activities. Interest received or dividends received can be shown under operating or investing activities. Some more differences between IFRS and US GAAP so far as cash flow statements are concerned. Let's look at. One area is the indirect method. IFRS, you know that guidance is provided under IAS 7. In US GAAP, the guidance for preparation of cash flow statements are provided under ASC 230. So in the area of relating to indirect method, IFRS income line as a starting point of reconciliation is not specified. So IFRS recommends actually direct method of preparing cash flow statement under operating activities. That's why income line as a starting point of reconciliation is not specified. Under US GAAP, in operating cash flows, the reconciliation from income to cash flow must begin with net income. So US GAAP basically, in operating cash flow, the reconciliation from income to cash flow must begin with the net income. So the net income must be the first item. So far as income tax is concerned, area of income tax, IFRS or IAS 7 requires that income tax is to be classified to the same activity, operating, investing and financing, to which it actually relates to. For example, dividend tax paid for dividend distribution, will be classified as a financing activity. Capital gains tax on a fixed asset as an investment activity, and tax on profits earned as an operating activity. So IAS 7 requires that income tax also should be classified to the same activity to which it actually relates to, like dividend tax should be classified as a financing activity, capital gains tax on fixed assets, sale of fixed assets, as an investment activity and tax on profits earned as an operating activity. Whereas under US GAAP, income tax paid or refund should be classified always as an operating activity, operating cash flow. US GAAP requires that income tax paid or refund should always be classified as an operating cash flow, not under any other head of cash flow. Interest and dividend paid and received I already explained to you. Under IS 7, there is option to classify interest and dividend paid or received as operating cash flow, or to classify interest and dividend paid as financing cash flows, and interest and dividends received as investing cash flow. But consistency is to be maintained. Under US GAAP, interest paid and interest and dividends received should be always classified as operating cash flow. Only dividends paid should be classified under financing cash flow. And the last item is cash flow per share. There is no restrictions on the disclosure of cash flow per share. If a company makes a disclosure of how much cash flow has been generated against each share of the company, that is called cash flow per share. There is no restriction on the disclosure of cash flows per share, but US GAAP prohibits the company should not disclose the cash flows per share. So under US GAAP, the disclosure of cash flow per share is prohibited, whereas IFRS doesn't prohibit disclosure of cash flow per share. Now we look at an exercise, small exercise, to understand how a cash statement is prepared. The following informations are given. So we look at the cash flow from operations. Dividend paid to common shareholders is $100. Retained earnings opening balance is 1,000, closing balance is 1,200. Account receivable opening balance is 500, closing balance is 600. Accounts payable opening balance is 400, closing balance is 500. Net plant and equipment opening balance is 1,000, closing balance is 800. Now you can see, for making adjustments of the working capital components, that's why we require the comparative balance sheets. We need to get the balance sheet of the last year and see what was the account receivable at the end of the last year, what was the account payable at the end of the last year, and all these figures will be available from the earlier year's balance sheet. We also take the current year's balance sheet and get the closing balances, and then we can make adjustments for changes in the working capital components. That's why the comparative balance sheets are required for preparing cash flow statements. Now here, based on the information given here, what is the net income of the business? Because our starting point for cash flow from operating activities is net income or profit figure in the income statement. So what is the profit figure is not given to us directly. We have the information regarding dividend, retained earnings, opening balance, closing balance, etc. So can we calculate what is the net income of the business? So net income of the business is equal to change in retained earnings plus dividend. Net income of the business is nothing but change in retained earnings plus dividend, because from the profit goes to increase the retained earnings and dividend reduces the retained earnings. So if you want to calculate the profit or net income, we'll have to find what is the change in retained earnings and add back the dividends which have been paid out of the retained earnings. So change in retained earnings is $200, 1,200 minus $1,000. So $200 is change in retained earnings and dividend paid is $100. So 200 plus 100, 300 is our net income figure. So this is the starting point for preparing the cash flow from operating activities. Now cash flow from operations, how much it will be? Next. So to arrive at the cash flow from operations, we have the net income figure, we have to make adjustments for the non-cash expenses and also make adjustments for the changes in the working capital components. So cash flow from operations will be net income plus depreciation plus increase in payables minus increase in receivables. So this is the adjustment for the working capital changes. This is a non-cash expenditure. So we are adding back the non-cash expense of depreciation and we are adjusting the changes in the working capital, increase in payables minus increase in receivables. Now what is depreciation? How much depreciation is there during the year? Can we calculate it from here? Net plant and equipment opening balance was 1000, closing balance is 800. So plant and equipment, how much depreciation has been charged on plant and equipment? 1000 minus 800, that is 200. That is the depreciation charged on plant and equipment. So depreciation expense is 200. So the figures will be net income 300 plus 1000 minus 800, which is the change in net in plant and equipment, plus increase in payables 500 minus 400 minus increase in receivables 600 minus 500. So we are getting 300 plus 200, 1000 minus 800 is 200, plus 100 minus 100. So actually the total comes to 500. So cash flow from operations is 500. If you look at these numbers, we can calculate what is the cash flow from operations. So you have to first get what is the net income. Net income is equal to change in retained earnings plus dividends, which is 200 plus 100, 300. From net income as a starting figure under indirect method, now we'll add back non-cash expenditure like depreciation, which is 1000 minus 800, 200, and we'll adjust for the changes in working capital, that is increase in payables minus increase in receivables. Then we arrive at what is the cash flow from net cash flow from operations. I hope the example makes it clear to you how under indirect method the net cash flow from operations is calculated. Any questions? Any doubts you have? Please have it clarified before we move to the next one. Next slide. Please tell me if you have any doubts regarding the way we have calculated the net cash flow from operations or cash flow from operations using the indirect method here with the help of the numbers given in this exercise. Is it okay? Any doubts? Then we will go to exercise 2. That will also help us to understand one more example for us to understand preparation and presentation of cash flow statements. So no question relating to exercise 1? Fine. Exercise 2. AB Limited has provided the information given in the following table. So net income before taxes figure is available, 400,000. Depreciation on property, plant and equipment figure is available, 200,000 non-cash expenditure. Loss on the sale of a building, 100,000. Interest expense, 150,000. Interest payable beginning of the year is 100,000. Interest payable at the end of the year is 50,000. And income tax paid is 100,000. So these figures are available. So can we create a cash flow statement from operating activities. With this available information given in the table relating to AB Limited, which are basically net income before taxes, depreciation on property, plant and equipment, loss on sale of building, interest expense, interest payable at the beginning of the year, interest payable at the end of the year, and income taxes paid, 100,000. So can we create a cash flow from operations? There are other figures also. Account receivable beginning of the year is given. Account receivable end of the year is given, 500,000. So there is an increase in account receivable. Increase in account receivable decreases the cash flow. Inventory beginning of the year 500,000, inventory end of the year. Inventory has gone down. The decrease in inventory will increase the cash flow. Accounts payable beginning of the year 200,000, accounts payable end of the year is 500,000. So accounts payable has gone up, that will also add to the cash flow. So you have to prepare the operating activities section of the cash flow statement using the indirect method, using these numbers. So we know net income before income taxes is 400,000. That figure is already given to us. Now we have to do adjustment for non-cash and non-operating activities. First we will make our starting point under indirect method is the net income before income taxes. So we have to do adjustments for non-cash and non-operating activities. So one of the adjustments will be relating to non-cash expenditure of depreciation. So depreciation has to be added back. Depreciation on property, plant and equipment 200,000. Then loss on sale of building, we have to add it back because it is also not relating to the operating activities. The loss suffered on the sale of the building, which is already included, which is already considered to arrive at the net income before income taxes, but that is not an operating activity, so you have to add back the loss on the sale of the building 100,000 and interest expense of 150,000. So total comes to 850,000. So 400 plus 850,000. Total comes to 400 plus 200 plus 100 plus 150. So basically we are getting, after adjustment for non-cash and non-operating activities, we get cash flow from operating activities 850,000. Here. Then we make for adjustment to changes in working capital. Increase in account receivable decreases the cash flow, so that increase in account receivable is 350,000. So it will be subtracted. Decrease in inventories basically adds to the cash flow, so 100,000. Increase in accounts payable also increases the cash flow, so 300,000. So cash generated from operation is 900,000. So after making the adjustments for changes in working capital components, we get cash generated from operations 900,000. Then interest paid. How much interest was actually paid during the year? So if you look at interest payable at the beginning of the year is 100,000. Interest expense was additionally 150,000, but the interest payable at the end of the year is 50,000. So 100 plus 150 minus 50,000 is the interest actually paid during the year. So interest payable at the beginning of the year was 100,000. Interest expense for the year is another 150,000. But the closing balance of interest payable is 50,000. So how much interest has been paid during the year? 100 plus 150 minus 50, which is 200,000. And income taxes paid is 100,000. So this adjustment should be made at the end. We got the cash generated from operations of 900,000. So we now subtract the interest paid during the year 200,000 and income taxes paid of 100,000 from the cash generated from operations. So net cash flows from operating activities comes to 900,000 minus 200,000 minus 100,000, so 600,000. So that is how we can prepare the cash flow statement using the indirect method for the operating activities section. Is that clear, or any doubts you have got? Please let me know your doubts so that I can clarify any of the numbers if you have a doubt about any of these numbers. If you are having any doubt with any of these numbers, please express your doubt so that I can clarify. So apparently no doubts. That's good. So we three categories of statement of cash flow. Under three categories, the cash flow or cash inflow or cash outflow will be reported: operations, investment, and financing. And order of presentation is operating activities will be presented first, investing activities will come next, and then financing activities. So that completes our discussion on cash flow statement. Unless you have any query, we end with the discussion on the cash flow statement. The next thing in the lesson 4 we will be talking about consolidation of financial statements. Particularly, we will talk about group accounting, we will talk about complex group structure, how IFRS is applied to different investment types. So we are talking of a company, we are talking of a situation where a company owns another company. A company has a subsidiary company has invested in another company, which may be a subsidiary and associate, the concept of group. So, in the situation of a group, we have so far been talking of entities separate, companies separately, each company separately. Each company prepares its financial statements and all that. What happens, there is a group of companies. Like let's say in India we have various groups like Aditya Birla group of companies. That group has got several companies. That group owns several companies. Tata group of companies. Reliance group of companies. So we have companies, there is a parent company which owns or have made investments in other companies in the group. So the groups, the financial position of the group, a financial statement of the group as a whole has to be presented. This is what is called group accounting. Consolidation has to be made at the level of the parent. So the parent company A owns company B, company C, company D. Company D owns another company, let's say company E. This 5 companies A, B, C, D and E, they constitute one group. The parent being A. So A owns B, A owns C, A owns D, and D owns another company called E. So this structure, this collection of these 5 companies, we call it a group. Now companies A, B, C, D and E will be preparing individually they will be preparing their financial statements. But at the level of A, which owns basically the entire group, which is the parent, a group accounting has to be done. That means a consolidation of the financial statements of all the companies in the group, that is company A, company B, company C, company D and company E, has to be made at the level, at the parent level of the parent, that is company A. So company A will prepare its own financial statement and also will prepare the financial statements of the group. This is what is called group accounting. So we will discuss about group accounting when we start lesson 4. We are going to start it today, but we will not go into much of details today, but we are going to just start it today to make you familiar with the concept of group and group accounting. So we will study and understand group accounting. We will learn complex group structures. There can be different kind of group structures. We will learn something about those complex group structures that are seen, that we come across. How IFRS or International Financial Reporting Standards are applied to different investment types. We will learn about what is subsidiary and what is the consolidation requirement at the level of the parent, and how to perform consolidation under the IFRS 10. So IFRS 10 is the standard which provides guidance for group accounting. So we will be discussing more about IFRS 10 In the contemporary economic scenario, in today's economic scenario, companies are looking for expansion of business. Companies try to expand their business. They sometimes form global business by acquiring or buying other companies, some of which could be domestic, some of which could be foreign. Like as you know, Hindalco, the Aditya Birla Group has a very has a company called Hindalco Limited, which manufactures aluminium. Hindalco in turn has acquired another company, Novelis, another company in Europe. So this is the way Aditya Birla Group is expanding. They are expanding their business by acquiring companies in India, by acquiring companies abroad. These companies together constitute a group. So group consists of basically holding entity which is called the parent and subsidiary company. So that's the example I am going to give you. If A is the parent company, A buys another company called B, it buys another company called C, C can buy another company called D. So A, B and C are subsidiaries of A, D is a subsidiary of C. So this is a group structure. Okay, this is what is called a group. So the form group consists of the holding entity and the subsidiary companies. This session will talk about group accounting. Group accounting aims to give us a true and fair view to the owners of a parent or what their investment represents, because the investment has been made by the parent. So what their investment represents, that is control and ownership of the net assets of the subsidiary companies. So group accounting is a complex and the biggest topics to be covered in IAS. Considering the timeline, scope and level of participants, this topic has been limited to understanding only the overview, underlying conceptual aspects of group accounting and roadmap to learning considerations ahead. So we will be basically restricting ourselves to understanding the overview of group accounting, conceptual aspects relating to group accounting. So that will be covered under the course. We will not go into much of details of group accounting, but we will be trying to understand what is its structure, how group accounting is done, how consolidation is done at the parent level. All these things will be discussing. So, but detailed discussion will take up in the next week. So I will request you to complete your feedbacks today, now, and if you have any questions relating to whatever you have covered so far, you can make your queries. Okay, thank you for completing your feedback. If you have any question, you can ask it now. Otherwise, we'll close the session today. Okay, thank you.